Hi, I'm Tom Lydon in Hollywood, Florida at the Inside ETF Conference here with Bill DeRoche, Chief Investment Officer of AGF Investments. Great seeing you, Bill.
It's nice to see you too, Tom.
Another great conference.
It is.
And there are a lot of advisors that continue to be optimistic, but boy, late 2018, that fourth quarter, they didn't have the confidence that they did today.
Yeah, fourth quarter obviously was a tough one. It showed that if rates go up at all, both fixed income and equities can suffer. We have a product that offers some insurance there. It did exceptionally well. People have been noticing it. Last year, the assets grew significantly.
Yeah. So the ticker symbol is BTAL, BTAL.
That's correct.
And the idea behind it is there's a certain quality to what you're buying and some stuff that you're short on. So explain how that works.
Yeah, so we like to, when we describe the market, most people will recognize that when the market goes down, volatility tends to spike.
Yeah.
The portfolio is long, low beta securities or low risk securities. It's short the high beta names. So as a result, when that volatility spikes and the market's going down, that spread really widens. Now, what it takes advantage of is this asymmetry. The market, as we know, when it goes up, it tends to go up in smaller increments. When it drops in larger increments. We like to use the analogy, it goes up like an escalator, drops like an elevator. People tend to get that. As a result, when the market is going up, this fund, it is insurance, it will underperform. If we use, say, 10% just to make the numbers easy, the fund will typically be down about 5% when the market's up 10%. But where it really comes into play is when the market's down. When the market's down 10%, on average this fund will be up 10%. Yesterday would be a good example. The market was down, the fund was up.
Yeah, and so advisors today tend to be more highly weighted in growth, more traditional market cap growth, which means that they've got very high concentration in fewer stocks, which again, if you're riding that wave and that doesn't change, fine. But that's not going to continue on forever.
Yeah, so we've been cautioning people when we look, say, at the next decade, so we try to think strategically. We look where multiples are right now. We look where interest rates are. We look for the ability for companies to grow their earnings, and we have much more lower expectations for the market in terms of the equity market. We're not suggesting we're negative, but we're just trying to caution people that it ain't going to be like the last 10 years. We're a little bit more concerned about fixed income. Yields are extremely low, so the expected returns you can get from there are going to be starting at that level.
Yeah.
But more importantly, when yields shrink, durations extend, what you thought was a low risk asset is a lot riskier than it was 10 years ago. So if you were to use, say, BTAL with your core equity exposure, you can create that balanced portfolio without any interest rate or credit exposure.
Yeah, absolutely. And don't get me started on triple Bs and where that may go, right?
Well, just look at last year, they did exceptionally well, so you have to be concerned, a little bit of reversion to the mean. So we're just trying to have people, rather than think very offensively with their portfolio, just get in that mindset that it's probably time to be thinking a little bit more defensively.
Yeah, absolutely. Bill, as always, great seeing you. Thank you.
Yeah, great friend. Thank you, Tom.
Thank you.
Yeah, appreciate it.